Hey everybody, this is Richard. Today I'll be doing a week 1 June performance review. At the end of this presentation though, I will be doing a correlation analysis between the S&P 500 and the 10-year note. So we'll look at quite a bit of data on that, and I'll basically to answer some of the questions I've been getting related to the correlation. In other words, is the inverse relationship still holding? So we'll look at some data on that, but before we get started, let's look at the risk disclosure. All right, so feel free to pause the screen here if you want to go ahead and read this. Just remember that trading futures does involve substantial risk of loss. It's not appropriate for all investors. And of course, past performance is not indicative of future performance. Finally, I'll just mention again that I'm not a CTA. We offer the algorithms under what's called a letter of direction, but we're what's called a third-party developer. Okay, so here's the performance for the Phoenix algorithm from the 29th of May through the 4th of June. So first what I'd like to do is just highlight the 10-year note. Again, we entered the 10-year way back here. You can probably barely see it, but that's that little blue arrow. And this is a weekly analysis, so really I want to focus in on this week. But if you notice here, the 10-year actually rallied fairly well, which was really good for us. In particular with the jobs report on Friday, we had a really nice pop. On the day trade algorithm, we had 2 trades actually. The first one was on Tuesday. That was a stop out. So we took a loss on that one, but then on Friday we had a really nice trade. In case you're wondering, Monday was a holiday. It was Memorial Day, but the futures market did trade for about half of the day. So that's what this little kind of blip is right in here. That's Monday, and so the futures did trade kind of in the morning, but then they had an early close. So we didn't really do anything on that. We tend to not have any trades on these holidays. But then on Tuesday, we had a big gap up. And like I said, the day trade entered into that, but then it got stopped out. So Tuesday, we took a loss. But then Friday, again, had another really nice pop with the jobs report. And we got in on the day trade. So for the most part, this algorithm did what it was designed to do. It would have been nice if it could have avoided this trade, but this will happen. So we kind of were up a decent amount on one and took a decent loss on the other. The S&P algo, so the momentum ES, that's this one right in here. And now that I'm looking at it here, this chart is a little busy, so I do apologize for that. But just to give you kind of a reference point, so every day has 2 candles. So like this big candle right in here is from Friday, and that corresponds to this trade right in here that we had on the day trade. The day before that was that would have been Thursday, where we had a big gap down and then a rally. So that's right in here, and then this is Wednesday, this is Tuesday, and so this red candle right here is actually Monday. That's that Memorial Day. So again, on the Memorial Day weekend, we didn't have a trade. But what the algorithm will do is if it generates a trade for that day, it ends up buying at the open the next day. And so that is by design. And so we bought at the open on Tuesday, and then it got stopped out pretty quickly. Then we got back in though at the close and got out of that trade on Wednesday morning, and then Wednesday towards the close we bought and hit our target. So we had 2 winners and 1 loser. Overall, though, I gave the algos a C-, and I'll explain why. But the profit loss on a dollar amount was about $450 loss. It was actually bigger than that beginning on Tuesday when we had those 2 stop outs. And so I know for most of my customers, it probably feels like we had a win this week just because of the way the algos rebounded. But they were down for the week, so we were down about $450. That's about 2%. So it's honestly, I mean, 2% is, in most cases, that's a pretty big move in anyone's account. But with these kind of aggressive alpha style algorithms, they a 2% swing is almost just break even. So it becomes almost noise in some ways. But the reason why I gave it a C is as follows, or C-. So the 10-year actually, that if I was grading it, it would have gotten 100%. The reason why is it rallied when the S&P also rallied, and again, it's more of a hedge for us. So if it can go higher with the S&P, that's our best case scenario. So even though we tend to not want those to be correlated, if they're correlated to the positive side and they both go up, then obviously that's still a good thing for us. So I kind of gave it 100%. The day trade algo, I think I gave it maybe roughly like a 70%. So basically a C. The reason why is it did have a really nice trade Friday. And if that's the only trade we had, then this would have been 100% as well, you know, an A. But because we got stopped out of this trade on Tuesday, the net was a loss. If you add these two together, it was a small loss of maybe $200, I think. So the fact that it was down is the reason why I just gave it kind of a break even. But this algorithm over here, the Momentum ES, that's the one that it's really a tough one to grade in a lot of ways, because the S&P did go higher, but it was really volatile. I mean, notice this is where previous Friday was at. Monday it was down, then you had big gap up, big sell-off, then sort of a sideways day, then a big gap down with the rally, and then another rally. And so you had this just looks like a big sideways pattern, but technically it was up. These sideways patterns are always the most difficult for the kind of momentum algorithm that we trade. And if you've been with us a while, then you kind of are getting an idea for how this works. So with the volatile days where you get a big pop in a rally like that, the day trade Phoenix is really the one that's trying to get a good trade. And by the way, if you're on the Pro Trader or the Crusher, you also saw this trade. It just would have gotten out a little bit later on those algos. But because of the volatility, we had a no buy kind of interjected in here. And the no buy is when it's either Monday through Thursday and the algo does not buy. And so like on 6-3 we had a no buy. But that'll happen, and that's what sort of protects us from the big down moves and helps get us on the sideline. But then when you have a pop like we had, then we're going to miss out on that. But again, one misses out on it and the other takes advantage of it. That is the day trade. So overall, I gave it a C, mainly because I would have liked to see the Momentum ES generate some profits as opposed to sort of maybe a couple hundred down. Mainly because when we have an up week like we had, my expectation is that it will generate some decent wins. And it did. I mean, it had 2 wins, but this trade on Monday sort of cancels it out. Or I'm sorry, on Tuesday. So, but that's the highlight of last week or this week. Well, yeah, I guess the first week of June. If you have any questions on any of this, let me know. But whether I give it a C or a C minus, it's a little bit subjective, I guess. If we would have been even break even or up a little bit, then I probably C plus. But because it was down, then I want to do the C minus there. But anyway, let's now jump into the correlation analysis, and so let's talk about that. Before I do though, just to help remind everyone, the reason why I'm doing this correlation analysis is because we trade the 10-year along with the S&P, and so what we like to see is that if the 10-year, if the S&P is going lower, we want to see the 10-year going higher. So we do want to see a negative correlation. But like I said, sometimes it works in our favor. But let's go ahead and look at it. And I think this will be interesting for anyone that's been with us for a while, especially if you're wondering about the 10-year and should we still trade it as a hedge against our long S&P position. So let's go ahead and jump in and look at it. Okay, so what you're looking at here is this is a correlation analysis between the S&P and the 10-year note. And this is for all the data going all the way back to 2002, roughly. That's way back here. This is 04, then 05, 06, 07, 08, all the way to 2020, and then where we're at now. So where it stands right now, and again, up here is the 0 line. So that's a 0 correlation. And as a reminder, if something has a 0 correlation, if 2 data sets have no correlation, that just means that there is no correlation. It's almost 2 random sets of data. If they have a, like a between 0 and positive 30, then it starts becoming a minor positive correlation. And kind of 0 to negative 30 is like a minor negative correlation. And that's about where we're at right now. Right now, the all-time, if you look at all the data going back, it's about a negative 27% correlation. But what is interesting, if you go back to 2016, you'll see it was at about a negative 35% correlation. And so it is true that since 2013, the correlation has held less and less every year, but it still has a very solid negative 27% correlation. But the other thing to keep in mind is this is a really big data set. This is almost 20 years of data, and what I did is I took the weekly gain or loss and just ran the correlation on that. But so keep in mind that this has all the data in it. So if we see a change in a year, even if it starts becoming positively correlated, this moving average will take, or this rolling average of the correlation will slowly go higher. So what I want to do now is look at kind of a rolling 1 year correlation. So what this is doing now is, instead of taking all the data going all the way back to 2002, it just looks back a year and says what was the correlation a year ago. And so and it kind of starts back here in 04. So 04 would have been looking at basically 2003 until the beginning of 04. And so what this does is it's sort of like a moving average, you could say. I mean, where this one gives you the all-time and it's sort of a much slower moving, this one will give you a quicker view of the correlation and where it's going. But notice how even with this 1 year, we still have a negative 20% correlation almost. As of Friday's close, that's what it was. And it is kind of interesting that if you look here in 2013, there was a period where it was higher and got all the way up to, it actually had a positive correlation. Same with 06. But again, this is only looking back a year. And so, but it is one way that you can try to look to detect any changes a little bit quicker. So feel free to pause this though if you want to look at it closer. I'll just highlight. Notice how in 2012 it got as uncorrelated as almost a negative 70% correlation, and but then it kind of starts bouncing higher. So there are, for the most part, if you figured out what kind of the averages of all this, you would land about where we are with about a negative 30% correlation. Okay. All right, so let's look at it one more layer though. So let's look at it with a 6-month rolling. And so what this will do is give us an even faster kind of view of where the correlation is. And what I want to highlight is right now it's actually at a positive 14% correlation. So if you look back 6 months, then we actually do have a positive correlation to the S&P. And a lot of you picked up on that. You noticed that there were times where the S&P was going lower and the 10-year also went lower. And then there's been times like this week where the S&P goes higher and the 10-year goes higher. So sometimes it will have a positive correlation. But what I want to highlight here is that notice though, when it's happened in the past, it tends to not hold. And so that is my expectation moving forward, is that yeah, we could still have some positive correlation, but it shouldn't hold and eventually should go back to a fairly good negative correlation. But what I want to do now is zoom in on the pandemic to kind of just show you again why I still am confident in the 10 years ability to help hedge our long S&P position. So to do that though, we need to look a little bit closer at sort of this period in here. So the next slide that I show you will kind of highlight just the pandemic period. But before I do that, I want to highlight this chart here. So this is just a weekly chart of the S&P and the 10-year. And you've probably seen this kind of chart quite a few times if you've watched my videos, because I'll show this quite a bit. Because notice when the before the pandemic, the S&P was kind of drifting higher. The 10-year was sort of drifting lower, but it was almost a sideways drift lower kind of feel. Then the pandemic hit, S&P sells off strongly, and the 10-year rallies incredibly strongly. So we had a very good for us negative correlation between the two. And then when the S&P started stabilizing and going higher, the 10-year started drifting lower, and that's actually what caused some of the losses that we saw. But then the last few weeks, the S&P's gone higher, and the 10-year also has sort of drifted higher, and that's why our S&P trade, if I go back to this slide, is actually up a bit, even though our 10-year is up, even though the S&P is also up. So again, that's good for us. But if we look a lot closer at, again, it's using this 6-month rolling correlation. But if we look at this period here and zoom in, that's what this is right here. And I wanted to do that to show you the pandemic, how the negative correlation held. So again, the pandemic really was going on kind of February, March, April roughly. And so I tried to highlight it with this red circle here. Even though really it would have been kind of starting back here, and then maybe, depending on when you say the end was, maybe in May, I guess. So it's really a shorter period, but because it's looking back 6 months, I wanted to capture a bigger kind of portion of that. But what I want to highlight is when the S&P was selling off, the negative correlation was very strong. It was actually in the negative 50%, and it went as low as negative 65% roughly. So that's really, really good for us. And again, negative 100% would be 100% uncorrelated. So the S&P is down $1,000, the 10-year is up $1,000. So the fact that when the S&P sold off, the negative correlation held, that's really good news for us, because what that tells us is that hopefully, and again, remember all the disclaimers, because none of this is 100%, but it gives us reason to believe that when the S&P does decide to sell off again in a very strong way, that the 10-year will hold. In other words, the 10-year will go higher just like it did during the pandemic. That's the expectation. Now, when everything is calming down, volatility is going lower, S&P's drifting higher, yeah, it's the negative correlation won't be as strong. And that can work in our favor, because notice how really since the beginning of the year, the correlation has been getting more and more positive. Well, that actually has been good for us the last couple weeks, because it's given us gains on our 10-year note trade. But what I expect to happen is that, again, if we go in, or when we go into another big sell-off, that the 10-year will rally strongly, and that negative correlation will hold again. All right, so that's kind of the summary of what I had for this week. Overall, this is a week where even though we were down, I know for most of us, it probably actually felt like we had a decent week, and in a lot of ways we did, because of the strong rebound we saw. But because we started out the week with a couple losing trades, it certainly is not well, trading's never easy, as you know, but these are the kind of things that do continue to give me encouragement that we're going to be okay, that we're going to pull out of this drawdown. Because when we have the losses, it doesn't take a lot for us to have some good gains to get those back. But it's also a good reminder that there's risk in trading futures, that it's definitely not for everyone, that there's an emotional roller coaster. Even though it is an algo, we still have to battle with the emotional side of it. But yeah, overall, I would say the week was decent, even though we were down. But that's only because of the strong rebound. So I'm looking forward to this week. Hopefully we can start adding to the gains, and close out June hopefully with some good wins. So that's definitely my expectation. But keep in mind, there's no guarantees. There's risk. If you have any questions though on anything, especially related to the correlation analysis that I did, feel free to reach out. There's a lot more that could be said about the correlation, by the way. I mean, this is a correlation between really just the S&P and the 10-year, as if it bought in 02 and just held the entire time. It just looks at the correlation. But there's other ways to look at the data. I've actually, in this same analysis, did a correlation between our algorithms and the S&P, just to make sure that, okay, do the algorithms hold a positive correlation in some cases and negative in others? And the good news is they did. They really, the correlation on those is pretty much what you'd expect them to be. The S&P algorithm has a positive correlation to the S&P. The day trade long Phoenix algo has a positive correlation to the S&P as well, but it's not as strong. and then the 10-year has a negative correlation to the S&P. And so it all makes sense, but I really wanted to focus in on the 10-year and the S&P just to kind of answer the question, is that correlation still holding, or do we need to start looking at a different way to hedge? And by the way, I'm always looking at other ways to have a position that would take advantage of an S&P going lower. So it's something that I'm always looking at, and I could have more to say on that later as more data comes in on some of the things I'm looking at. So anyways, thanks so much for watching. If you have questions, feel free to email me at sales@AlgorithmicTrading.net. Yeah, looking forward to next week, and I hope you have a great day. All right, bye-bye.